All right, come on in, make yourself comfortable. We're going to get started in about 30 seconds time. All right, everybody, come on in. I'm going to get started in about 15 seconds. Countdown. All right, well, welcome to your December webinar. My name is Jeff. I'm a director at Evalesco, and I'll be your host for today. And I'm really excited to be joined today by my fantastic business partners, Jules and Marshall. So welcome back to the webinar, guys.
Thanks, Jeff.
Thanks for having us.
Today we're going to go through a year in review, and it's certainly been quite a year, so lots to talk about. We're going to cover that from the viewpoint of financial markets, as well as lending and that side of things as well. And then I'll give you a little bit of an update on what's been happening within the business towards the end of the session as well. Before we get into that, I just want to let you know that you at home today are on mute and your cameras are turned off, so we can't see or hear you, so feel free to move around. We would love you to ask questions as we go through. So you'll see at the bottom of your screen there's a Q&A button. You can click on that, type in your questions, and we'll endeavour to answer those on the way through or come back to them towards the end of the session. But we would love to hear from you if you do have questions. Also just want to let you know that most of the conversation we have today will be about general financial markets, general financial topics. So giving you a general advice disclaimer in that we're not taking into account your personal circumstances right now. If you would like to know more about what we talk about, how that might apply to you, then please get in touch with your advisor or one of us, and we'd be happy to cover that off. So with that intro out of the way, I'm going to share our screen. We've got some slides to run through, and then I'm going to hand over to Marshall to kick us off. Bit of a lag on the computer here. There we go. Over to you, Marsh, to kick us off with the investment side of things.
Thank you, Jeff. Good afternoon, ladies and gentlemen, and welcome. Merry Christmas to all. So the next 20 minutes or so, I'm going to walk you through some information with regards to, I guess, an investment update. So within the business here, for those that aren't fully aware, I wear a few different hats. So certainly I'm a director and owner of the business. I'm a financial advisor as well. My team, we manage about 80 portfolios, or rather 80 clients' financial affairs. And I also sit on the investment committee. So within the team here, it's my role to effectively be their voice and to meet with fund managers and to research, maintain, and to continue to build portfolios. So it's certainly fair to say that conversations that we're having with clients this time of the year in 2022 are a little bit different to what they were in 2021. So if we sort of cast our mind back to December 2021 or thereabouts, certainly returns across all asset classes were generally positive. Thinking about most of our investors, they're invested in what we call the core and growth strategies, and they were probably having review meetings in December 2021 with their advisors and looking at double-digit returns across the board. Fast forward today, it's a little bit different to that. What we had started to pick up and identify in the, I guess, the quarter ending 2021 is that some of our managers were starting to become what we call correlated. And that means that they were buying some of the same securities, and we were starting to get a little bit cautious or a little bit of concern around that. Quarterly rebalancing continued to happen, which meant that if there was any profits throughout the year, we were taking those. Many of you that are homeowners would certainly be aware of the difference in what's happening with cash rates. So December 2021, we were still looking at cash rates of, I think, about 10 basis points. And it had been a couple of years really since there'd been any movement in that marketplace. We're now looking at over 3% or 3.1% for cash rates, which is very different. Inflation, we'd heard a lot of, I think, commentary towards the back end of 2021 that inflation had started to appear on people's radars. However, the expectation that it would be transitory and fairly short-term in nature. Towards the end of last year, we'd started to make some changes to the fixed income portion of our clients' portfolios, and that's things like bonds and essentially that topic or that point there that you can see around duration. So we were investing more in very short-term interest rate securities, not 10-year or 30-year government bonds, to protect our investors. And at the end of last year, certainly active investors or active portfolio managers had delivered better outcomes than the broader market. So that was some of the conversations and themes this time last year. Now, if we move forward to, I guess, some observations and considerations from 2022, the year started off with, some certainly more challenging macroeconomic events and geopolitical events with Russia's invasion of Ukraine that brought volatility back to portfolios. We hadn't really seen that for quite some time. Really since COVID kicked off. Central banks started to make some decisions around cash rates and started to move interest rates certainly far earlier than expected. If I think about the Australian marketplace, the RBA was really on the record, I think it was only middle to late last year, of saying they weren't expecting to move interest rates until late 23, 2024. Jules, I'm not sure if I'm taking any of your
No, you're fine.
content.
I'll recap on what actually happened, but yeah.
But certainly, as an IC, when volatility started to pick up, that's when our concerns around what some of the decisions that our portfolio managers were doing comes back to this conversation around correlation. And when we had two of our fund managers buying the same securities in around March, we made some decisions to add in some more defensive elements to the portfolio, which essentially saw us put in businesses that are more top 20 major brand names that would ensure that in terms of the income flowing into your portfolio, you have a greater level of dividends and also that sort of flight to security, which is what often happens when investors become nervous.
And so what was it about the correlation that you saw as being a risk or an issue?
Yeah, so Jeff, when we build portfolios, we want to make sure that we have managers that have a fairly clear brief as to, I guess, the type of investment that we want them to make. And ideally, they're doing different things so that at one point in the cycle, one manager might be doing slightly better than the alternative. But over time, we want them to be, selecting great businesses. And what we found is that the two managers, if they had 20 positions in their portfolio, at the end of 2021, effectively they had 14 to 15 of the same positions. So that increased what we would consider to be concentration risk within the portfolio. Now, when all things are going really well, that's fantastic. But when markets become a little bit bumpy and some of those investments are in businesses that do very well in a low inflation, low interest rate environment, that started to change. And our concerns were that certainly for the next couple of years, those businesses would be impacted.
So we're really looking at, everybody knows about diversification and the value of diversification in the portfolio, but that's a sign that just because you've got different managers doesn't necessarily mean you're getting diversification.
Correct.
Because they are investing in the same things, which is something that, it's important to look through and that carries through to a number of different areas in putting the portfolio together as well.
It is. And it's easy to see that within the portfolios, you can see the direct shares within your portfolio. And that is essentially one of two investment managers making those decisions. But we also look at what's inside the managed funds, which are not often as transparent. That takes a little bit of work to do. And that sort of leads me to that point on the screen there around activity. So typically the investment committee members will meet with the portfolio managers and representatives of our active partners or active fund managers at least twice per year, sometimes 3, and those that we would consider to be on the reserve bench. So for every investment portfolio, every investment manager in your portfolio, we have reserve bench options. In the event that someone is underperforming, there's been staff turnover or other concerns, there's someone that we can bring in quite quickly. Now, when markets become more volatile or something significant happens, our activity levels increase. We're typically in dialogue with each of the portfolio managers sort of every fortnight. There's weekly conversations that occur between investment committee members so that we're sharing intelligence and information, and to make sure that we're sharing up-to-date information with our advisors so that they can communicate with you, our clients. And certainly at an Evalesco level, you probably would have seen greater communications from our marketing team that we're hitting your email inbox, more webinars hosted by Jeff to make sure that you got the right information to make informed decisions. And that's where I guess the last 2 points there come into place around discipline. So it's really important that both as an investment committee and also as an advisor, we keep our heads and sense of balance and sanity when others are kind of losing theirs, because that's all about financial leadership to ensure that we're delivering better outcomes for you. And you do that based on information and making sound decisions. Now, the final point there would be investors that had an exposure to what we call the index core strategy. One of the things that we started to introduce within some of our portfolios was that we wanted to come up with had this concept called a finishing fund. So the investment committee, we're not making day-to-day decisions in terms of allocations within the portfolio, which securities to buy and hold or sell. We rely upon the investment managers to do that. So when things became more volatile, we introduced an additional strategy to some of the portfolios, which allowed for more tactical decision-making, which is the perpetual diversified real return fund. I'll let you control the mouth. I'm seemingly ineffective at that. Yeah. So on this slide here, just want to give you some sense as to some of the decisions that have been made over the course of the year. As I touched on the AM Index Core previously, for our accumulators that are invested in the growth model, 20% of your portfolio would have been sitting in that strategy, which is effectively a low-cost exposure to the Australian share market, international market, and also some of the fixed income strategies. So what we did in that with that portfolio, and some of our retirees will have an exposure to that, is that we allocated 10% of that to the perpetual strategy, which meant that we had professional investment managers making decisions around individual markets that really we don't have access to as financial advisors or investment committee members.
So I think just to build on that, a key part of owning an index fund is you just have to buy whatever's in the index. So given that the diversified index like that is made up of government bonds, you have to own a lot of 10-year government bonds, perhaps 30-year government bonds, even though you know it's a poor investment at this point in time in the market cycle. And so that was a big part of that decision-making, wasn't it, to move away from those?
Yes, it was. So we allocated 10% to perpetual, but we also allocated some of that capital to the index growth, which effectively removed the fixed income or duration risk from the portfolio for growth investors. In addition to that, I touched on the concerns around some of the managers becoming correlated, and we made the decision to effectively remove one of the better known Australian equities managers in the marketplace, probably one of the best performing over the last 3 to 5 years, in favour of something that would add a little bit more, some more defensive considerations to the portfolio and improve dividends via the BlackRock Top 20 model. So if investors look in their portfolio now, you'll see a lot more of the major businesses, the larger banks, which we would expect to be more resilient throughout this period. And Outside of that, the couple of other decisions that were made, we removed for those investors that have an exposure to the sustainable growth strategy, in line with what Jeff talked about with fixed interest, we made some changes to that strategy as well to better protect our investors. And we've also added an international share manager called Lazard to once again provide some better downside protection to that portfolio. Certainly one of the key learnings throughout this period, and from a policy viewpoint, is we've effectively incorporated a strategy or a series of strategies called the 4 pillars approach, so that we have greater levels of diversification within the portfolio and also equal weighting, so there's no what they call style bias. Okay. So a bit of a summary, some of the things we're thinking about or that we expect to be rolling out over the next 2 quarters. With regards to the 4 pillars policy, we do expect a couple of small changes to some of the portfolios. And some of those are as a result of, I guess, the scale that we now have, the number of families that are invested in our portfolios, both within Evalesco and also the broader group. It allows us to have conversations with investment managers that are almost at that institutional level. So within the Australian equities side of the portfolio, we've been able to engage with an institution to effectively build a strategy for us that is quite bespoke, but allows us to tailor that so that it has all of the best defensive characteristics that we want from the portfolio at a really favourable price for our investors. So I expect that you'll see more on that in the first quarter of next year. In terms of the sustainable growth strategy, we expect that there's going to be a little bit more change within that portfolio. Over the last couple of years, those that are invested in that portfolio have had a greater allocation to things like IT and other businesses that might be impacted by higher inflation, higher interest rates. So we want to make sure that once again, investors in that portfolio are as protected as those that are in our broad-based growth strategies. Final 2 things I'll touch on in relation to sort of the where to from here. Fixed income or bonds are typically the defensive portion of the portfolio. And some of the decisions that we made both last year in the core model and this year in the growth model have certainly allowed our investors to be better protected. So broadly speaking, some of those long duration bond strategies, some of those have fallen between 14% and 18% over the last 12 months. And whilst some of the equities markets have been quite volatile, you don't really expect fixed income to fall by that degree. So I'm really happy that in the main we've been able to shield our investors from exposure to that sector. But what I expect is that over the next quarter or 2, we might start to dip our toes back into that market, so that as interest rates changes start to moderate, they don't continue to move forward as strongly as they do. That's when some of those long duration government bonds might be more attractive again.
Yeah. And so I think that's, those big falls have been driven because interest rates went up so quickly, so unexpectedly, because normally when you're pricing something like that, you've got a bit of warning and you can sort of price it out, can't you? And that was because at the start of the year, if somebody bought a 10-year government bond, they might have got 0.5% income on that. And now you can buy a 10-year government bond and you're going to get 4% income on that, or potentially a little bit more over the next couple of months. So no one wants the one paying 0.5% anymore. So it's gone down in value by 14, 15, 20% in value. So, and then I guess I think you're going to touch on as well. The good thing is now you're actually getting an income return on your fixed income portfolio as well. So rather than getting 0.5%, you can actually get 4%, which is a pretty solid income. So that makes that much more attractive to start thinking about moving back into those sorts of areas as well.
Yeah, it does. That's correct, Jeff. And to go a step further, some of the Australian securities might have been offering interest rates of 0.5% or a little bit less, but even some of the global bonds overseas, they were negative rates because that's how pessimistic and concerned people were. So, you know, you're spot on. Essentially, people really, once you're invested in those and new issuances are coming out at 3, 4, 5, 6%, no one wants the old ones. They want the new ones. And, you know, that's where you've got to be well positioned to ensure that you're not exposed there. And it's also fair to say, if you think about a typical retiree portfolio, you would typically have sort of 30%, give or take 30 to 40% in fixed income. And for a number of years, cash and fixed income has earned very little. So that has meant that your equities have had to work doubly hard to compensate for that. So we're expecting that 30 to 40% is now going to start to generate incomes of sort of 3 to 4%, which should take some of the pressure off the broader portfolio. Okay. The one thing I'll touch on as well, that bottom point there, is in relation to liquidity. There's been a real growing trend over the last couple of years for both certain institutions, major superannuation funds, and some financial advice firms to allocate more and more capital to strategies that are unlisted. So we would typically invest in listed businesses, listed property, fixed income, and by unlisted or illiquid, I'm talking about private equity, I'm talking about commercial buildings that are not listed on the share market, private credit. Now, at various stages, some of those strategies can deliver great outcomes, but the challenge as well is that they're not repriced on a regular basis. So your share market investments are priced every single day, and you know categorically exactly what they're worth when markets close each day. There are a number of investors out there that have exposure of 20 to 30 to 40% to some of these unlisted strategies. And if you have a business, whether it's listed or private, if businesses have fallen 30% in value over a 12-month period, that should apply to both listed and unlisted strategies. And what that's leading to is some strategies looking like they're delivering really great outcomes, but the reality is that it's because those businesses haven't been revalued yet. And I often liken it to, if you think about your family home or investment property that you might have, you really only value that like formally when you're buying it and when you're selling it. And if you were to auction your property every single day for a year, you'll get a different value every day. That's the impact from a liquidity viewpoint.
Yeah, and what we're seeing in that space, to continue your analogy, is if your 5 neighbours sold their house and they all sold them for lower values than what they bought them for 12 months ago, you could sit there and say, well, my house hasn't gone down in value, which technically it hasn't because you haven't sold it.
Correct.
But it would be very surprising if your home hadn't followed them, at least on an average basis, which is what a lot of these institutional investors are doing with their property portfolios.
That's right. And if you kind of look past the headlines, you've also got to, conspiracy theorists to me would question how some of the investment professionals might be remunerated as well, which is probably based on asset valuation. So you would prefer to maintain the higher valuation.
Yep.
A couple of the major superannuation funds, when COVID really kicked off, the government allowed early release of superannuation, were impacted. They had to effectively quickly sell down some of their listed strategies because they couldn't quickly sell off the building when a lot of members were wanting to access their superannuation. Okay. I've got a slide here, and I certainly don't doubt that both Jules and Jeff will further expand on this. Some of my sort of key talking points, both at a client level and also within the IC. When things get bumpy, I always talk about your personal economy. So without a doubt, there are headwinds within the economy. Some of the businesses are going to be impacted, but the things that you can control immediately are typically your ability to earn an income, ensuring that you're consistently spending less than you earn, to make sure that all the assets are working as hard as they possibly can. So to try and not get trapped by the headlines and the doom and gloom, if you've got relatively secure employment, you've got a good business, you're generating great income, spend less than you earn and allocate that capital to productive means effectively.
Well said, Marsh.
Okay. And I mean, that's the sort of conversation that we have with some of our advisors too, to make sure that, you know, Jeff, Jules and I have been through more of these cycles than some of the younger advisors. And, you know, sometimes old heads can add a little bit of value from time to time. In terms of the defensive aspects, this is what Jeff touched on before, in the sense that some of the defensive parts of the portfolio we're now expecting are going to start to deliver some better outcomes for our clients. Whether that's cash, term deposits or bonds, we expect that that will deliver better returns for you. In terms of income, you know, effectively, one of the things that we're looking at the moment is in a high inflation, high interest rate environment, we want to make sure that as much of your rate of return is being derived from good quality dividend flows, and we'll maximise those where we can, and to also provide you with some downside protection. The last 2 points there really sort of talk about some of the things I think we've done this year that have really added some great value to our clients. So certainly, unashamedly, I work with primarily retirees. We've got 80 families that Matt, Jenny and I work with. And of those, I would say 60 would be retirees. We've had quite a lot of conversations this year with retirees that have said, look, we want someone to work that's trusted with some of our family members. And that has allowed retirees with larger account balances to effectively ensure that retirement savings for their children are accelerated because of fee savings and synergies there. But it's also removed some sense of possible anxiety at the dining table or with family conversations, because they now know that they're all working together. Clearly, each other's affairs are not disclosed, but they know that they're getting trusted guidance. And quite often it might be from a younger team member. So not all of the kids want to work with me. They sometimes might want to work with Mel or Mia or Hung. And, you know, the final point being the put us to work piece, which is really around ensuring that, you know, we've now got specialist advisors within our team, not just generalist advisors that might have a particular niche. You know, Jules and her team very much specialise on delivering outcomes for our clients that have mortgages. There's been some amazing outcomes for clients that the parents have got a home and Jules has been able to secure financing for the children buying their first property. You know, you'll probably talk about the interest rate protocols that you go through, reviews. And the last one being Dom, who's our specialist insurance advisor. So he's supported a number of families at claim time this year, really instrumental in delivering great outcomes for them.
Great, thanks, Mark. Good overview of what's happening in the investment. So as I said, if any questions, please type them in and we'll endeavour to cover those off. But in the interest of time, we'll keep moving and head on to Jules to talk about year in review from a lending viewpoint, because there's not much has happened from a lending viewpoint.
Oh, not much at all.
Been
all pretty boring, but all jokes aside. So yes, I'll jump straight in. Headlines, I suppose. Everybody wants to kind of, you know, look at their biggest asset, which is their home. Usually they're looking at housing markets and thinking, yeah, so that the property price is about to, you know, plummet. But in actual fact, they're still, 22% higher than they were in September 2020. Obviously, there has been a fall since April of, on whole across the country of 4.8%. But yeah, in relative terms, that doesn't look too bad. So obviously the RBA cash rate is in the big talking point back of Marsh's presentation. So 3% over 8 months. So it's pretty, pretty extraordinary increases in a short space of time. And obviously mortgage holders feeling that more than anyone.
And probably just for some of them, it's only just starting to feel it now, isn't it? Because it takes a while for that to come through from a cash flow viewpoint. And
yes,
in the first couple of us got, a lot of our clients have got a bit of buffer, but then, another one comes through, another one comes through.
Yeah, talk a bit about that. So a lot of our clients have used this, low interest rate environment to their advantage. The ones that have had the loans for a bit longer, but those newer borrowers are feeling it certainly more.
Yep.
So purchase prices do remain high. Obviously, cost of living has gone up with inflation. So we are seeing affordability and borrowing capacity impacted. So a lot of clients finding that they just can't borrow as much as what they could have this time last year.
Yeah.
So, you know, the prices might not have dropped as much as what their borrowing capacity has.
Yeah.
So, you know, it's a bit of a challenge trying to get in.
Yeah.
So as I said, budgets being stretched, consumer spending, however, has remained relatively high. So, you know, but as you said, Jeff, there's still this fixed rate cliff yet to come. So, you know, in 2023, we're expecting, when those fixed rates come off, there's going to be a bit of a, you know, shock. There's a lot of people's budgets, so there will be more tightening, I would imagine.
Because quite a lot of homeowners would have had rates in the 1s and low 2s.
Correct.
So
Yes.
2 to 3 year windows.
Yes. Yeah. We saw, you know, lucky you if you got one at 1.79 was probably a fixed rate that was getting around for a while, and some are still in the low 2s. But yeah, we'll talk a little bit more about that.
Okay.
Because it is a huge impact on the budget. So so obviously, coming to next year, we'll see what the RBA do, but still, seeing, I suppose, the impact of those rate prices flowing through to inflation. So shifting, you know, global economic environment, as you said, Marsh, there's still a lot to play out. So there's still some mixed opinions on what might happen. But
It's challenging, isn't it? Because like in the Australian marketplace, we're almost at full employment. And, you know, that also leads to inflation, because when everybody's employed, you know, there's a lot of wage pressure, which also leads to inflation.
Correct.
So, certainly the rates haven't started to bite at an employer level yet. And when that does, you might start to see some changes.
Yep, absolutely. Payment in March, record low of 0.1%. So May was the first rate rise, and all the way through to December last Tuesday to 3.1. Probably the point I wanted to make there was about if anyone has had a loan for longer than 10 years, hopefully they can cast their mind back, and it was actually 3%, the cash rate was 3% in December 2012. So just, those
Exactly 10 years ago.
Exactly 10 years ago. So we're pretty close to kind of where we were then. But obviously inflation's still rising at the moment until that's kind of leveled out. There's still forecasts of further rises. 2 of 4 of the big banks saying 3.85 is where they see it capping out. Possibly around summer, early to mid 2023, but most of the banks agree, and it will remain steady. So hopefully, if we can prepare for that as a kind of a worst case, then we can start planning, household budgets and rate repayments to hopefully start leveling off there. Let's not get ahead of ourselves and talk about rate cuts just yet, but 2024 is kind of the earliest case scenario that most of the banks are predicting as a potential rate cut.
So what do you think that means for fixed rates? Because, we talked about good opportunity to lock in a fixed rate at 1.79%. Obviously, we're a long way from being able to access those again. But, if we think rates might start topping out, next year and then maybe coming off in 2024.
Yeah.
Do we start thinking about fixed rates or?
Well, this is what we're seeing is in the marketplace, we talk about standard variable rates and fixed rates. Fixed rates tend to be what they are, what they publish. Standard variable rates are very variable between lenders. So, so as much as you might look at it on the surface and think, fixed and variable, maybe they're starting to catch up with each other, because fixed rates have been, they went right through the roof kind of thing, and everyone went, oh my goodness, don't go into fixed rates because they've just, become really, really expensive. But having said that, variable rates are still very much negotiable. So, that's where I kind of look at it. Don't assume that fixed rates are actually, now on par or, looking more, better value, but because to be honest, when you start negotiating, it's still quite a bit of margin between the two. So, I feel that there's still some room, there to just, sit tight and don't fix when rates are going up generally is the rule, because we end up paying, you know, overs, and then you're locked in, like as some clients, again, that have had mortgages in the past. I remember talking to clients again around that 10-year ago mark, and they were, you know, all very, you know, regretting that they'd locked in a fixed rate because they freaked out at the time, and it was, you know, 5.5%, and obviously rates went right down to 1.8. So let's, not get too hasty there, but as you say, Jeff, fixed rates have already priced in a lot of these increases. So let's I'd say let's negotiate on the variables and see how we go there.
Cool.
So yes, housing market, again, surge off the back of COVID, as everyone knows, you know, got in kind of right at the start of the pandemic. You'll probably got yourself a good deal, and saw your property go up, you know, somewhere in the order of 20 to 30%. But as I said, the current downswing is the fastest on record. So it's not huge, but it's fast. So obviously Sydney's currently leading the decline, which obviously is no surprise given that, you know, Sydney's got the highest property values, and, you know, down 9% from January through to September. However, as I said, home values remain 22% higher nationally across Australia than the 2022 level, 2020 levels. So I guess to give people some comfort and not, you know, think that it's all doom and gloom with either their home or their investment properties. Just kind of want to make that point. The average hold period is 9 years property. As financial advisors, we generally say buy and hold, and, you know, hopefully keep that property unless it's a dud in your portfolio, unless there's some opportunity cost there. But if it's a solid property, you just want to buy and hold. But so it's assuming that 9-year hold period, even with double-digit falls, they're still, you know, sellers would still be looking to make a gain. So it's not all bad. It's just, you know, it's just sudden and probably, as you said, headline worthy. Basically back to the same adage: don't react to headlines. Talk to your advisor and make sure if you are thinking about selling, it's for the right reasons, not because you're getting on, the emotional kind of bandwagon of what's happening in the market.
I think it's interesting if you reflect on the pace of the decline, but then you match it up with the pace of the increase, because that meant the prices went up by over 30% in 2 years. So if it goes like that, then it's more likely to go like that. So what, I always kind of say, I'd rather see it just, start to go like that a little bit over the next few years, because that might, reduce the likelihood of another big crash, and we don't want to get too greedy and we're trying to make all that money back in a short space of time.
Correct. Yeah. And again, obviously the people that are feeling it most are those buyers that bought 12 months ago. And so they're only seeing falls, so they don't have that, the benefit of that in hindsight. But long term, again, work with us on making sure you can, keep paying that property off, and long term, don't look to sell in the short term, and you'll be right. All right. So just on lending. So again, off the back of those kind of changes, I suppose in the rates, there's been obviously a lot of rate rises on home loans. So I'm just put it on. If you look on, say, a comparison website like Mozo, they're saying average rate is about 5.44. Internally, what we're seeing is more like 4.79. So obviously, if you're out there paying in the fives for your home loan, come and talk to us, because we think you're probably paying a bit much. But again, that's what I was saying before. There's a big variation in rates between lenders. So that's a point that I'll come back to. So borrowing activity obviously has slowed, because obviously the factors being that borrowing capacity is reduced, property prices have fallen, so people tend to be a bit more cautious about going into into any new debt. And yes, obviously with inflation and budget pressures, but still New South Wales new loans sitting around about 740,000. So it's still pretty high when you think about it as an average, and that's New South Wales. So it's not Sydney. So Sydney's probably higher again. Said before, clients with loans that have had them for 10 years or more probably are withstanding these rate rises a bit better over the last couple of years. If they've taken our advice and stuck with either making the same repayments or higher payments than they were before the rates dropped, they've gotten well ahead of on their loans, so they're in a good position. Again, the borrowers that have taken out loans during this low rate period, let's see those with the fixed rate that we talked about, or those that have kind of just scraped through on their, affordability, borrowed at the maximum, paying the minimum, they're the ones that need to be concerned, obviously, in this current environment, because they've budgeted, obviously, payments that are possibly a few $1,000s less per month than what they are faced with now. Fixing obviously hit record highs, said in 2021, and put my hand up and say we put a lot of clients into fixed rates in that period. And there's which is great. So we've got clients that are still on those great fixed rates till either next year or even 2024. However, obviously that party's got to come to an end at some point, and between July and December next year is what we're seeing as fixed rate cliff, where some of these borrowers are going to be in a bit of strife. Not our clients, of course, because we'll have managed that through with them. But let's kind of see what happens, as I said, with consumer spending and potentially the property market around that time. So there might be, with the kind of predicted rate rise still to come, we're looking at maybe variable rates about 5.75. So coming off 2.82 or so, they're looking at about 3.6%, which would be around $3,000 a month extra on a $1 million home loan. So put in perspective, where does someone find $3,000 a month after they've been used to paying obviously a certain rate of payment? So definitely affordability is harder now. So for buyers, so then said if you were looking to buy last year, you might have been given a borrowing capacity assessment at a certain amount, thinking, go out and buy. But this year, we're not seeing the same affordability. Just remember too that you might be able to afford those payments. A lot of clients sometimes challenge us and say, hang on, I can afford those payments at the current rate. That's okay. I've done my budget, and and again, as financial advisors, we make sure that before you make any of these big major property buying decisions, that you can afford payments. However, banks assess it at least 3% and higher. So that's where the affordability comes into it. And the other point I want to make about interest-only loans, so we've had clients talk to us about extending their interest-only period. And at the time they borrowed, they could have obviously comfortably afforded that interest-only loan according to the bank's servicing at the time. They might find though now that to run that same, borrowing capacity assessment, that they're not able to, because interest-only loans have got to be assessed at a 25-year term or a 20-year term, if whatever the term remaining from when they took it out. So they've got to actually be able to afford much higher payments than even just standard
for when they do
principal for when it does fall off the interest rate period. Yes, again, so don't assume just because you've got an interest-only loan that we can extend it. It's not that easy, but certainly come and talk to us and we can have a look. But maybe the fact that you've got to pay principal and interest. All right. So so I've kind of touched on some of these points, but I'll just revisit this. So for existing borrowers, obviously the main point there is review your loans, because variable rate loans, as I said, can be extremely variable between one lender to the next, or even if you've been in a loan product for a number of years and potentially haven't looked at it, probably paying too much. So the lenders are still very competitive, like they want your business. There's a lot of rate wars and cashbacks and things going on still. So as much as we're in a higher interest rate environment, there's still a lot of competition, so which is great for borrowers. So make sure that either you or you're getting us to ask your lender to renegotiate. As Marsh said, we do this as a matter of course. So at the moment, because of the current rate environment, we've got my team reviewing these every 6 months. So basically, as soon as the banks allow us, which is generally minimum, 6 months. So they don't let us, unfortunately, review every month, but we could go back and try and push for a better rate. And we're seeing some really good discounts there. So by all means, if you haven't, or if you're not an existing lending client of ours, please ask your bank or come and talk to us. If they don't play ball, sometimes they don't. Obviously, then we will look at whether it's better for you to refinance. But yeah, and we'll do the calcs and make sure that it's in the best interest to do that. But yeah, don't just sit on your hands in the current environment because you will be paying too much. Yes, fixed rate cliff is coming. So yes, prepare for that, prepare early. So what we do is put a repayment strategy in place now so that you get used to making those repayments. So it's not like a bill shock factor when they do fall off. And most of our clients put into fixed rate loans doing that already. But again, let's look at that when it's ready to expire and see what we can do. And then property buyers, yeah, again, don't assume that just because you were looking at a property last year and now think, oh, I can get a bargain because hopefully property prices have come down. And last year I was told by the bank that I could borrow $1 million. Well, then it might not be the case this time around. So talk to us first. We can do a full borrowing assessment. So very much like to give our clients the certainty that we've looked at their borrowing assessment as though a bank. And if anything, to be honest, sometimes we're telling the credit assessors how to assess things. So we know our staff will do a proper full borrowing assessment so that you're very well prepared to go to the property market and know what to afford and not get yourself into any trouble. Yeah, and obviously get the right rate and the right strategy. So yeah, come and talk to us about any of those things and we're happy to help.
That's great. Thanks, Jules.
Okay.
So the key takeout for me on both of those, I think, is really to, keep the lines of communication open. So if you've got questions, if you've got plans, if things are changing in your circumstances, come and talk to us about it. It's never hurts to get a second opinion and do a bit of review on your portfolio or on your loans as well. So that's what we're here for. So we'd love to hear from you on those. We've come right up against our time, but I'm just going to do a very quick, give you a bit of an update for those who are interested in something a little bit more casual before we head off to Christmas. Update on the business. So very quickly. So from a business viewpoint, this is the first year in living memory that we haven't had any new legislation imposed on us, which imposes new rules and requirements for how we work with our clients. So that's been pretty exciting. Having said that, we had, they called it Black October in 2021, where there was a whole raft of things which you would have seen around fee consents and ongoing service agreements and things like that, which we've been working through this year. So that's been the challenge, but no new legislation, which is great. Within the team, we added 8 new team members this year who joined us. So that's Virginia, Queenie, Joanna, Kurt, Yan, Elle, May and Ashley, which has been fantastic. So we've had a couple of people who moved on. So there's a couple of replacements, but mostly new people in the seats, which is great. We also had Mia return from maternity leave. So another fresh perspective on things as she's back at her desk as well, which has been fantastic. So this is really positioned as well for continued growth and to hopefully continue looking after our clients. We've received a lot, as Marsh sort of mentioned, a lot of really kind referrals and introductions this year. And because we've now got some more support and some more resources in the team, we feel really comfortable in being able to keep up our service levels and help more people. So again, as Marsh said, if you've got people that you think could benefit from having a chat with us, we'd love to hear from you and have a chat with them, see how we can help. As you would know, we ran a client survey at the start of this year. We've got lots of fantastic feedback on that. So a lot of very constructive feedback and a lot of really kind messages as well. So one of the key takeouts from that was a net promoter score calculation. So that is, I guess, a globally recognised metric on service and ongoing patronage. We got a score of 52, which was good. So Bain & Co, who were the creators of Net Promoter Score, would say anything above 50 is excellent. So we just snuck above that, which is really good. We're very pleased with that. However, they talk about world-class being an 80, a score of 80. So we've got a bit of work to do there. So some of that feedback has been incorporated into the webinars that we've been running, some of the communication we've been sending out. Hopefully you'll see some more of that come through over the next 12 months as we continue to learn from that as well. Some of the key words that were provided in that feedback included responsive, friendly, knowledgeable, great team, and providing confidence. And another key word was Melody. So obviously Melody's clients are big fans, and I'm happy to share the feedback on her, which is fantastic. On a more, I guess, personal level for the team, we had two new babies join the Evalesco team this year. So Matt and Lisa welcomed Ari, who's a little brother for Ivy, and Kate and Jason welcomed Elle in the last little while. So Kate's on maternity leave, but I know she's nervously watching at home right now to make sure that we don't stuff this up. So and Elle was on her lap just beforehand. Kate and Jason also got married earlier in the year as well. So it's been a big year for them. Virginia joined the team and also got engaged this year. So big year of change for her. And right now, many of our team have already jetted off for their holidays overseas. So first time in a while, paying very expensive airfares, but keen to get over there. So people visiting family in USA, Ireland and Mexico, and then on holidays also in Europe, where it's apparently very cold. So that's, I guess, a bit of a summary from the business. We had some really nice awards and recognition. So Marsh was a finalist in the IFA awards and also recognised in the top 50 most influential financial advisors. Jules and Christy were both finalists for many awards this year in the lending space, which is great recognition. And Hung was a finalist for a young advisor, which is 30 years and under in the IFA. So he was quick to remind us that he's got one more year to go because he's turning 30 next year. So he's going to have another crack at it next year. And so that, I guess, in a nutshell, wraps up a little bit about what's happening in the business. We're feeling very optimistic about what next year holds. Certainly some more headwinds from investment markets, from a lending market. There will be some challenges, but we think we're well positioned as a team and with the portfolios and the processes we've got in place to continue to support you. And we'd love to see you again on Zoom, or come in and see us in the office, because we're certainly open for business back in here as well. So with that, I'll wrap up. We'd love to wish you a very Merry Christmas and look forward to a healthy, wealthy and happy 2023. See you next year.
Merry Christmas.
Thank you.